Welcome, welcome. Godric here, your stock market mentor. Friday night, October 25th, 2024. Welcome, Pablo. Welcome, T minus. Appreciate you. SK Enzo. Welcome. Deanna Rowe. I got your care. Your stock market mentor. I'm gonna do some stocks tonight, Friday night. Probably do a short one tonight. You know, this is an extra day. I mainly come on Mondays and then maybe a day or two. But I wanted to touch base on a couple things. There was a couple trades that went down this week. Wanted to talk about that. You guys want to take notes? I got my journal. Got my high quality pencils. Got the erasers. All right, so first of all, I want to thank you guys for subbing, and thank you guys for following. We're building a community of sorts, and mostly talking about stocks, and which a lot of us have enthusiasm. I appreciate all the people sharing, and just coming and asking questions. I think a lot of people don't know how to do stocks but want to. And those that are doing them, there's a lot to. There's always stuff to learn. When I show you a trade today, maybe you've heard of it, maybe not. I think it's worth time looking at it. It's in Tesla, and just see if you can follow along, and if you want to share, ask a question. That's what I'm here for. And if you want to follow along, and you want to share, just check in Monday nights. I usually come on around between 10 and 11, pack time. Talk about stocks, talk about trading. I specialized in earning money monthly to generate income, to pay all your bills, and retire into the stock market. As I've been showing you guys. Appreciate you. Give me some likes if you guys tap that screen like a video game. Pat, 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 pat. Let's get some likes up. Get some people in here. This algorithm, Appreciate you. I'm going to take questions in a little bit. Behind you is a trade. Maybe you've heard of a company called Tesla. Tesla Motors. Back in the day, let's say maybe like 2005 or so, 2010. It was just getting going, and the stock was kind of like hot. I remember it was about $150, and I was doing some trades. Didn't really care that much about it. Heard about Elon Musk. Didn't really care about him either. But it's just the electric vehicles were getting going, and Tesla's kind of been the main game since before. It was always the main game. So stock was going up, and just stayed with it, and the stock was like $150, and I remember making some money in it. I was in it for by around 50, and at that time, it was a different time, but same things were happening. Good stocks were going up, hot stocks were going up, and that Tesla stock went up to about 1,000, and then it split down, and then it went back up again to like 1,000, and it split down. So, and now, recently it had a 4-for-1 split, I guess, recently. And now it's back down to 200s. And I want to show you what happened just a couple days ago in Tesla before the earnings. Log in my account. Because some of you guys want to learn how to do trades. And this is one trade about trading the earnings. Some of you guys know how to do this, but if you don't know how to do it, I'm going to show you. hang on 1 second. So there's what I call tricks to the trade, right? So there's always like things to learn, and one of the tricks to the trade is to trade earnings, and earnings comes every quarter, every 3 months, and all the companies on the S&P 500 report earnings, and Tesla report earnings this week, okay, and click on research. U.S. is always, I think, where the money's at. You really have to diversify. If you want to diversify from the U.S., I would just go like gold or like silver. I wouldn't go other countries. That's just me. Just because, unless you really know where that money's going. Okay, so check it out, guys. I'm gonna do a 5-day chart, right? Okay, Tesla was at 213 on the 23rd, October 23rd, okay? So what happened is they announced earnings. Now, one of the trades I want to show you tonight is real simple. It's basically you buy a call and you buy a put for $1, in this case for Tesla. And here I show you, you go out 1 month, right? So we go forward to November 22nd. In this case, you're gonna buy the put. The 160 was the one that paid $1. See how it has $1? And this is an example of how you trade earnings, right? So a 1-on-1 means it's gonna be $100 to buy this call option, right? And it shows I bought 3, and it was I'm looking at it, 300. It was $300, okay, to buy 3 calls. All right, and then you do this before the earnings are announced, right? And then let's see, we can I'm gonna get the call for you. So you buy 1 call and you buy 1 put, right? And the call, the call as $1 was at 285 in November. Let me show that to you. I have to scroll it back. It's back here a little bit. And the point of it was we're buying the put for $1, and we're buying the call for $1. Looking for that call for you. Here's the put. Okay, here's the call. So here's the call. This call is $1, $1.02, and it shows here 3 contracts plus 3 right in the middle there. Went out 1 month from October to November. In the middle there shows November 285 call, and that was also $300. So what happened was the earnings were announced, and 2 things are going to happen mostly with a lot of stocks, and also at Tesla. If you follow Tesla, it generally either goes up or down, right? So a trade like this, the theory of it is that you'll have $1 option which will increase by a great amount, okay? Now you buy the put and the call so you can have both ways. Both ways you're protected. I mean, both ways you get action. So whether the stock drops, that $1 put will go up. Whether the stock goes up, the call will go up, right? The call option, because stock went up, right? And that $1 call will go up probably a lot, right? And the alternative is that the stock won't really move that much, right? Let's say the stock didn't move. So if the stock didn't move, in this case, those call options wouldn't really return money. It would just kind of like, instead of being $1, it'll be like, it'll lose like 80 cents. It'll be like 20 cents, right? So in this case, you lost, right? But what generally happens with Tesla, with other hot stocks, is generally when the earnings are announced, it'll pop up if the investors like it, and it'll just dump down if the investors don't like it, okay? This is what happened with Tesla. So the next day, okay, it was up 40 points. Okay. See if I can bring it up for you. McDonald's. I want to talk about McDonald's too. They had E. coli and then coli unaliving, and like 70 people reported sick. So that stock was down. Okay, this is a buy opportunity long term. Okay, it was like 315, then it was down 16. It's like 298. This happens too. That would be like if you like McDonald's, buy opportunity, because generally they'll make a legal settlement, they'll pay out, and the stock will go back up. And that's all. It's going to happen with food companies. Remember, like it happened with Chipotle a couple years back. I took some pictures for you guys. Give me one moment. Here's Tesla again at 213, down 4 points. Now, I also want to say this, if you can write this down. When a stock is down 4 points, it's a good time to do a put, okay? Or when your stock is down, it's a good time to sell a put. Because when you sell a put, you're going to get money. You're going to get more money because when the stock dumps, the put is higher, right? So if you want to write down in your journal, when the stock is down, sell the put. When the stock swings up, sell the call or sell the covered call. Here's an option chain. I was doing some trades. Here's PLTR. Notice has a lot of volume on PLTR. This is another good one, PLTR. Write that down. I did trades on PLTR and Tesla both. Okay, now here's the trade, guys. You ready? So the next day after they announced earnings on the 24th, this is just, I guess, yesterday, the stock bumped up 40 points, all right? Let's take a look at what happened to the call, guys. Thank you for the likes. Give me some more likes, please. Let's get those likes up there. November 280 call. Actually, this is not the right call, but the call went up. But this is not the right call. I had a 285, right? Here it is. The November 285 call. See how I have 3 there? It went up to 563. All right? From $1 to 563. 450% return. Do you see that? Up 461. All right? Now, here's the thing. A lot of times your stock's not going to be up $40. Okay, this is like an exception, but you're only putting $1 in this trade, so it's not like it has to hit every time. You know what I mean? You can hit miss. But if it hits, you made like 450%. The $300 investment went to $1,700, and you can see the profit of $1,400. You see that? Now, that's if the stock goes up by a large amount. Let's look at the put. Here's the put, the 160 put. Well, this one went down. This one would have went up if the stock went down. But it did not. Tesla had good earnings. The investors liked it. They bought the shares. The stock went up 40 points. And the put went down from $1 to 21 cents. So here it shows the loss, $250 loss, because it had an 80-cent loss. And then the total loss is there. But as you can see, in this case, when you buy the put and call, if the stock moves a lot, you can't lose, because the call, if it goes up, is going to be more valuable than the loss in your put. And if the stock dumped, which we know Tesla has dumped, or a lot of stocks have dumped on earnings, the put would have been more valuable than the loss you would have in the call. So you have both. If you have both covered, it's a win-win. Okay, and that's the trade I want to show you. Give me some more likes, guys. Thank you for the likes. If you throw me a crane. Appreciate you. Just throw me some cranes or flowers. I won't say no. Some stars. And if you want to sub, it's only $5 a month. For the subs, I answer your DMs. I answer questions, advise on trades. Just one question at a time, please. Okay, so you can buy the put and the call just for $1. So you're gonna go way out. So the stock was 213. the call we bought was a 285 for 1 month out. If it's October, by November. If it's November, you buy December, right? And the put we bought was 160. So it was like 50 points below, 50 points above. Actually, like 70 points above in this case. So the investment was relatively small. I mean, the return was kind of good because if you're investing 300 on the put, 300 on the call, and they end up getting back $1,400 profit on the call, and we only lost about 300 on the put. The total profit was like $1,000. It's like it's still more than triple your money, with both the loss on the put and the gain on the call. So the alternative is if the stock didn't really move, which doesn't happen that much. Usually on the earnings they go up or down, but the stock didn't move. Let's say it would go down 40 cents on each way, and you'd probably be losing half of your investment, you know. But if it hit, I mean, in this case it did, you get this kind of like 400% gain, you know, triple your investment. So there's the result. This is just want to show you guys. There's a call, went way up, $1,400 profit, and the put went down, but it's only $250 loss or so. So that's the difference. So that's one way you can play the earnings. It's risky because we don't know, earnings can be hit or miss. But if you cover both sides, it's kind of like, in this case, you can't lose. You know, you lose only if the stock didn't dump or pop, and you probably won't lose that much. You'll probably just lose a portion of the options. Okay, guys, make sense? Questions? If I miss your question, just put it down again. I'm going to roll back. I can't roll back that much. Okay. Matthew, appreciate you. Sanchez, welcome. Max, welcome. Jordan, thank you for the likes. Thank you, Jordan. Jordan's the man. Jordan Allen. Everybody follow Jordan Allen. He's the man. Okay. Braden, welcome. Joe. If you have any questions for me, just drop them down there in the comments and I'll get you questions. I'm going to show you a couple more trades. We don't got to go that long tonight, maybe 45 minutes. That trade, I'm going to say that trade is not that well known. I didn't really learn that trade until maybe 10 years ago. I've been in the market for like more than 30 years. A lot of people are gambling. Like, if you know how to take the risk out of stocks, then it's not gambling. Like, if you know how to pick the great stocks, you know how to do the great trades, you're taking the risk out. So it's not really gambling. If you just pick a random put, a random call, pick the random stock, threw a dart at a dartboard, ask the monkey to type, to throw dice, that's random. That's gambling. In that case, it's just better to go to Vegas because you can get free drinks from a waitress, and then you can gamble. You might as well gamble. Might as well get free drinks. But if you have a stock market investment, learn how to do these trades so it's not just gambling. It's not just random. Okay, appreciate you guys. Thank you, Jordan. Everyone follow Jordan. Jordan's the man. How do you play the earnings again? Do you buy a call and sell a put? DHF, dude, you gotta help me with your name, bro. How do you play the earnings again? Do you buy a call and sell a put? You buy a put and you buy a call. So you're betting that it's going to go down, and you bet that it's going to go up. And you do it one day before the earnings, and you go out 1 month, and you buy the option that's $1. And I just said $1 because I don't want you to spend too much money. It's kind of like a risky long shot investment, but it actually turns out more than it doesn't turn out. And when it turns out, you're going to get mad money. And when it doesn't turn out, you're not going to lose that much. That's the whole thing. It's a mathematical advantage I'm going to show you. But again, it's not with every stock. You got to have a hot stock like Tesla that's great, that people are going to have a great... Look at the volume on Tesla. Here, look. The volume on Tesla is 161 million today. right? See, the more volume, the better, okay? Because if there's more volume, there's more investors, there's more people in that stock trading, buying options, buying stocks, buying shares. And they're going to buy those options that you're buying, and it's going to help ride the price with more volatility. In this case, you're buying a put and a call. The share price was 213 on the 23rd. We bought the 160 call, so we bought 50 points down. We bought the 185, I'm sorry. We bought the 160 put, 50 points down. We bought the 185 call, 70 points up. Each one was $1. You just pick the one that's $1. And $1 is just a general figure. You can spend $2 or 50 cents, but the idea is you don't spend too much, because when it's at $1, the leverage is high leverage. And in this case, it hit. Stock was at 40 points, and the call option went from $1 to 5 something. Now, that option, this option today went up even higher. Like if you just held on, see now, I would just close right away. If I have a 400% gain, 450% gain, I would just close. But what happened is the stock went up again today, 6 more points, 8 more points actually. And I'm going to show you the price of the option today. That same November 15, November 22 actually, call option is 11:30. So it doubled again. So it's 11:30. Go check it out. November 22nd, 285 call for Tesla, $11. So it doubled from here. Okay. So and again on the trade, if the stock doesn't really move, those options are going to kind of get more quiet and sell down. So maybe it'll go from $1 to 50 cents or 20 cents. So you won't lose everything. But if they pop, $4, $5, times 4, times 5, So write down your journal. Have a proper journal. Write the date. Write the trade for, in this case, How to Trade Earnings by Godric. And you're going to buy a put in the call like 1 month out for $1. And ideally, if the stock pops, it's either going to pop or dump. If it pops, you get more money on the call than you lose on the put. If it dumps, you get more money on the put than you lose on the call. Make sense? Questions? Appreciate you guys. Give me some more likes. If you guys give me 2 shares each, I appreciate you. Just share it down, bottom right. Hit the share button. Send it to 2 of your friends. Get some more people in here. I'm answering questions. I can talk about a couple more trades, but I really want to hear from you guys tonight. Like, what do you guys want to do? I can look up your stocks. You want to give me a stock? I'll pull it up. I'll tell you what I think. Don't be upset if I tell you it's trash. I have a strict criteria for what I do, and I have a lot of red flags not to do. I have a lot of green lights, check marks. I have a lot of check boxes. Okay. Opinions on UNG. Jack made 72% on Amazon calls today. Cross guy, it shows a cross by your name. Made 72% on Amazon today. Awesome. Amazon calls. Awesome. Get that money. Oh, so you buy a put and sell a call. No, you buy a call and you buy a put. God, come on, guys. I do sell calls. I sell calls all day. I sell puts all day. But the trade for earnings is you buy a call and you buy a put. You're buying both. You're getting both sides, okay? If it dumps, you'll make money when it goes down. If it goes up, you make money when it goes up. You understand the idea of going short. Do you guys know how to make money when you go short? Do you understand what's happening? Like, I've explained it to you, and a light bulb turns on, Like, I can explain it again. Like, if you have if you buy a put, you want the stock to go down. If you buy a call, you want the stock to go up, right? So in this case, you want either one is going to pay you. And the more volatility you have, the more like it goes up or down, the more you're going to get paid. That makes sense. Is that too much? I can tone it down. I can talk slower. All right. UNG. Was it UNG? Do you think about DJT puts? Crossman. What do you think about DJT puts? Right now, Donald J. Trump stock is going up. So I would do the calls. I would go long. But, like any trader, you got to capture those profits. So have a protection. Have, maybe a sell stop or a limit order to where you're going to protect your profits because, yes, it can come down. I think the tide has shifted. I think it's probably going to win and it's probably going to go up. But if it loses, I think it'll come down. So in that way, it's risky. I wouldn't just do puts. I would go long right now, and then if it changes and it starts going down, then you switch to puts. Right now, it's going up. Follow the trend. They say never fight the trend. You can't fight the market. If it's going up, you got to go long. Just like we got a new high on the S&P 500. We got a new high on the Dow Jones. We got a new high on Palantir stock today, 45 something. Go long. Go with the trend. If somebody was going short on this market, they would be getting clobbered. It's facts. So you got to go with the trend. You got to go long right now. Okay, UNG. And AG is up 20% for me. Jack, AG is up 20%. Everyone follow Jack. Jack's giving some stocks advice here. Okay, opinions on UNG. Jack, let me pull up your stock for you. Don't be upset. But I'll tell you what my criteria is. UNG, I hope you said UNG. United States Natural Gas. Are you serious? This is a stock? Can I read it? Let me read it. United States Natural Gas, New York Stock Exchange, ARCA, $14.33. So right there you have a missed check mark. It's not a red light. It's not a red flag, but it's not a check mark. A low price stock like this is probably problematic because where did it go? It's $14. Who made money? You know what I mean? You want to have a robust share price. It's showing me a 5-year chart where the stock was $127. UNG, U.S. Natural Gas. So investors went from $127 to $14. So like they lost like 90% of their investment. Is this really happening? In 2022, after COVID, they had a double top. You guys learn how to do charts. A double top is bad. Had double top at 127. The stock went all the way down. It just dragged and dragged. It's still going down. So it's in a downtrend. Let me look at this. In the 5 years ago, it was $90, and now it's $14. So right there, that's a big red flag, going down, losing money. 6-month chart is maintaining. So it's maintaining on a 6-month chart. So maybe what you're thinking is someone told you, your father-in-law or something, told you, hey, look at the stock, it's going to go up. It may have hit a bottom, okay? Not saying yes or no. But just the fact that it lost so much money is very problematic. You're looking right now at a oversold, stock that maybe would be going up in the future because it went so low, a double. There's a double bottom actually in July and in August. And then a triple bottom if you want to count October. So based on that, it may be going up. But so far, it's a no. Volume is good. 6.2 million. So I have a check mark for the volume. Share price X. We want a robust share price. $100, $200, $400. Netflix $700. Because what? Apple's $200, Tesla's $200 something, $260. Why? Because high share prices mean that the stock's going up and up and up and up, and people made money because the stock went up and up and up, and it's highly priced and it's hot. If you have a $14 share price, it's been beat up to hell. it's gone down. It hasn't really gone anywhere. In this case, it went from 127 to 14. So we have an X on the share price. We have a check mark on the volume. We have a X on the volume share price. We have a check mark on the volume. We have a X on the volume share price. I'm not going to bring people up right now, unless you're subbing. If you're subbing, I can bring you up. Let me get this out. Give me like 2 minutes, okay? Fund strategy. The investment seeks to reflect the daily changes in percentage terms of the spot price of natural gas delivered at the Henry Hub, Louisiana, and measured by the daily changes in price and specified short-term futures contracts. The fund invests primarily in futures contracts for natural gas that are traded on the New York MEX, NYMEX, ICE futures, Europe ICE futures, benchmark futures. So it's actually, there's no employees that are working for this company. This company is a fund based on the gas price. So right there is another problem, because it's like following Bitcoin or following the dollar or following a commodity. It's basically a stock that's following a commodity. So there's no employees that are going to work harder to make this stock go up, which is going to happen for Apple, for Coca-Cola, for Pepsi, for Netflix. This is just following the natural gas price. If the gas price goes down, the stock will go down. If the gas price goes up, the stock will go up. So based on that, I say that's also an X. Let's look. I know it's not going to have dividends. Is it? No dividends. X. I know it doesn't have any stock splits. X. I don't even have to continue. It has no PE because it doesn't make money. It doesn't sell a product. It just goes based on the. So I'm just going to give it a no. I'll just just wrap this up. But thank you for that, UNG stock. I don't like it. If you're really like a gas person that follows the gas price, I always do the commodity just because this is why. Just do the gas commodity on the commodities market, because these guys are taking a cut. This UNG, this guy, whoever made this this company, is taking your shares that you're paying, and they're getting their cut, and they're not giving you the exact gas price because they always take their cuts as a fund, right? So there's a middleman. So that's why I wouldn't do it. It's kind of like kind of like when you do a mutual fund. Like you have a guy that manages $1 billion, manages a bunch of pensions. He does a mutual fund. He gets a bunch of stocks together, and he has a nice gold tie. He probably drives a Bentley, works at a big building, a big ass sign on the wall, floor of traders with desks, pins and stuff. Ass sign on the wall, floor of traders with desks, pins and stuff, computers. Their cut. They're not doing that for free. So anytime you have someone that's managing a fund or controlling something, they're taking a cut. I wouldn't do it. Go directly to the source. Just go buy the gas. If you think gas is going up, just go buy the gas on the commodities. You can even leverage it if you want. Okay. Sorry about that. Okay. Questions. I can roll back only so far. Just put your question in again if I miss it. So sorry if I miss it. Questions. Oh, I'm not holding shares. I'm playing calls. 217. Jack. Oh, I'm not holding shares. I'm playing calls. 217. Jack. You wanted to go 17 or higher, or you just wanted to go up. You're doing calls. So like Jack's doing calls on the stock. So if it goes up, all right, his calls are going to go up because they're going to make money. Okay, but here's the thing. This stock has done so shitty. It's gone down from 127 to 14. It's like a disaster zone. Like whoever got in at 127 is going to be physically sick because they've lost 90% of their money. So someone got taken here. Now, The good news for Jack is there's a triple bottom in July, in August, in October. That's what I look at. And the volume is decent, 6 million a day. So it may start going up. But again, the gas price, I mean, there's so many factors that's going to, you have to know the gas price for some reason is low and women go higher. Maybe because it's the winter, I guess. You want to play it that way? Okay. Jack, thank you for the question. Yeah, if you can get a gain, I would just, pull the trigger, take your gain and walk away. But someone's taking a cut to do all this. They ain't doing it for free. Someone back here has a Bentley that made this all this. They ain't doing it for free. Someone back here has a Bentley that made this whole stock skin, whole gas price. Look what I can do for you. Whole stock skin, whole gas price. Look what I can do for you. I can follow the gas price. The shares went down from 127 to 14. Talking about the earnings play. The earnings play on UNG. On which one? You can always do an earnings play, but why not do an earnings play on a great stock? When I was showing you these check marks and these X's, what? A stock that has high volume, more than 2 million a day. It has a good 10-year chart, which means it went from the bottom left to the top right. Instead of going from 127 to 14, it went from 14 to 127. One stock is NVDA. NVDA. I have a 5-year chart here on Schwab. They don't have a 10-year chart unless you change your chart pattern. 5 years ago, NVIDIA was $5, and now it's $140. So can we say 28-fold, 28 times your money in 5 years? This is the stock you want to play earnings on, okay? Or Tesla. Let me bring up Palantir. Palantir is not a great stock, but it's a low price. If you guys want a low price stock, $44.76. 5 years ago, it was $10. So it went up 4 times in 5 years, okay? This is a better stock, okay? It's going up. 50 million volume a day. That's what I'm talking about. It's not a high share price, so it kind of sucks on that. No dividend, no stock splits, but it has a PE. It's showing a PE of 250, which is ridiculous. But 250, hey, profit's profit. It's probably making 1 penny profit, right? And Palantir does what? Government contracts, and things are heating up in the Middle East, right? So we're gonna need, counterterrorism, government contracts. This one's gonna be probably going up, probably going 50 or 60. And if you're doing call options, you get that leverage, 400%, Yeah. So Palantir, Tesla, what's the other one? Palantir, Tesla, and NVIDIA, yes. UNG, no. That's just my take, I'm a little bit strict. DKNG, is that Donut King? What is that? Is that a stock? Crossman, DKNG, is that a stock? DraftKings, oh, dude. Ooh, DraftKings is a great idea. I'm not gonna lie, but I know they have no profits. How can they not have profits? You know what it is, I think? I'll tell you what I think it is. You know how, the casinos always struggled on the share price? Though that you think they're making money, right? The stock slumps, Bally's and Caesars Entertainment. What's the other one? The Mirage, Because I think they're paying the mob. I think that's why. They got to pay, Fat Tony. That's why I think these stocks don't do that great. Because no reason a DraftKings can't have a profit. I go right to the PE. PE for DraftKings, dash, losing money. Market cap, 18 billion. I like to have 50 billion market cap. So for market cap, we get an X. PE, X. No profits. Losing money, no market cap. Share price, 36. No share price, X. We want a robust share price, $100, $200. 5 years ago, Why? Because 5 years ago, DraftKings was $20. So it almost doubled in 5 years. Not bad, but you can do better. It does kind of maintain, the chart does kind of maintain. If you like DraftKings, it might, inch up to 30, 40, 50 bucks. It could happen. 8 million volume. It has the volume check mark. I'll give you the volume check mark. No dividend. No dividend. X. No share. Stock splits. X. Can it double? No, because it hasn't doubled in 5 years. Can you buy the product? Yes, you can buy the product. They get a check mark. You can get DraftKings app, and you can bet on all the football players, individual. Appreciate your questions, guys. This one, I think. Oh, you know what? It has a cover call. I think I can give it three check marks out of 11 with a cover call. Let's get a cover call for DraftKings. Why not? Hit options. I love cover calls. I get to pay my bills, and if you do it right, you retire in the stock market. So you go out 1 month, right? So it's the 25th, October. So you go November 20. Let's go 29th. Close enough. 33 days. You buy stock here at 36.39, $3,000, 3,600 investment. Buy 100 shares. And we're gonna write, yeah, it has a cover call, definitely. We're gonna write 36, 39. Write this down. 1 cc cover call, November 29th. So in October, you go to November. November, you go to December. Well, 1 month, okay? Go to October 29th, and we're gonna go higher. We go 38, 39. The 39 cover call gives us some share growth. So we're going to buy the shares here at 36, 39 and sell the 39. 39? The 39 call, which means we agree to sell the call at a higher price, 39, and for that we get paid 148 premium. Which is kind of whack because the bid ask, the spread's too wide. So scratch that. We're going to sell the 38, okay? Because 38 has a 202 by 214. And we can always do a limit order, guys. But it's easy to do the market order with the shows on the bid. Like, if you're going to do a cover call, or in this case, if you're going to buy an option or buy a stock, look at the bid ask. If there's a big spread between, then what you want to do, instead of going market, you want to put a limit order between the bid and ask, or somewhere in between, to save you some money. So, like if it's 148 bid and 175 ask, I would try to sell the call at like 160, which is more than 148. And I do that because, one, a lot of volume. Someone will probably buy that call from you, and then you can sell it and get paid money. In this case, it pays 148, so that's not enough for us. I'm going to go the 38 call, pays 202. So you're going to get $202 for every 100 shares of DraftKings every month. $3,600 investment, making $202. Let's do the math. Get your calculator, guys, with me. Calculator. Confirm this with me. 202, which is a premium for the cover call for agreeing to sell the shares at 38, divided by your investment of 36.39. $5.55% return. Excellent return. 5.55% ROI, return on investment. That's for 1 month, and you do it every month. Let's just say 10 times, because you can mess up twice and still do it. 55% return for the year. You can put $3,000 in this company and get 55% return for the year. You're doing 10 trades, you're doing 10 cover calls. You're getting 5.5% return every month. What would $200 do for you every month? Maybe buy you some Starbucks. buy a few meals, maybe pay for your gas bill, help you buy some gas in your car. You want to make more money, just increase your investment, 200 shares, 300 shares. Every 100 shares, you can do a covered call. Or what they say, you can write a covered call. And write a covered call is very similar to, I say, the analogy I use, to an a real estate investment like a 10-unit apartment that you can rent the rooms. So you buy this apartment, you rent the rooms for money, for monthly income. And those renters pay you to stay there. You're getting a monthly income on your investment. Similarly, with covered calls, you buy lots of 100 shares. You're selling the call higher than the share price. In this case, you buy at 36, you sell it at 38. That way you can gain more money if the stock goes up to 38. But what you do in a covered call, you give up the upside, some of it. So if the stock swings past 38, you give that rest of that money to the option buyer. You just take your $200, and you also take the distance between the share price, which is 36, 39, and what you agreed to sell it for, the strike of 38. You'll get another 170. So you'll get a total of 372, which is a great return. But if the stock goes up or down, you're still going to get that $200 at premium. Whether it's 140 or 160 or 200. Tesla's paying us about $1,500 a month now, between $1,000 and $1,500 a month on the cover calls. And that's also paying 5%, more than 5%. So anyways, DraftKings is good for the cover calls. I don't like the stock. I don't know. I don't have the faith in the stock because it hasn't done a whole lot in 5 years. No profits. No, none of these things I'm looking for that make a stock great. A high share price, no. PE, no. Dividends, no. Stock splits, no. You can buy the product. Hang on. Yeah, I gave it a check mark for that. DraftKings operates a digital sports entertainment and gaming company in the United States and internationally. It provides online sports betting at casino daily fantasy sports. You get this media and other consumer products as well as retail sports books. The company also engages in the design and development of sports betting and casino gaming software for the online retail sportsbook and gaming operations. In addition, it offers DraftKings Marketplace, a digital collectibles ecosystem designed for mainstream accessibility that offers curated NFT drops and supports secondary market transactions. I know NFTs are a thing, so they probably make money off that too, so that's good. But I can't help but think that these guys on DraftKings, like any casino, is going to do what they can to rob the customer who's betting on these numbers on these athletes. Because didn't they have litigation? Didn't they just get sued for employees of DraftKings betting too much in their own platform as employees because they have an advantage? Because they can break the rules that we have to follow. So there could be some litigation there, just saying. And if you trust these dudes to pay you to run a fair game in a casino, on a casino app, I don't know. I don't know what to say. But I'm sure that there is value here. I just don't see it. It's just not what I'm looking for. But there's a cover call anyways. You can do well on the cover call. And the reason why a lot of you people won't do a cover call, I'll tell you, because most of you dudes are young, healthy dudes. You're working and making some money. You want to triple your money, quadruple times 10. You want to get this option that goes up 400%. I get it. Making 5% a month is not going to do nothing for you. You want to get 1,000% per month. You want to be like Wolf of Wall Street. I understand, dude. I saw Wall Street, Michael Douglas, 87. The dude what is it? Blue Horseshoe Les NVDA. The dude makes $800,000 in a day. That's what you guys want, and that's why you won't do cover calls. That's why you don't want to do any safe trades. I'm trying to tell you, I take the risk out of it for you because I really no risk. Whether it's you're doing this earnings trade that I mentioned, or you're doing cover calls, making 5% a month, or you're just doing dividends. Just do some dividends, right? There's not that much risk. Like if you pick random companies that your father-in-law or Kramer advises, they're selling those to you. Those companies are probably trash, you know. If you don't vet these companies, you're just gambling, you know. And once you learn how to do these trades, when you learn how to pick better stocks, real companies that have real employees, that provide a real service, that have a product that goes to 100 countries, and you can buy the product and have a great 10-year chart history, those ones are better. Those are going to give you a better return. Those are probably going to be here in the next 10 years. A lot of these companies are just like any other business. 11 out of 12 businesses fail. Facts. You can't just throw darts at that board. You got to have a strict criteria. I'm going to show you these things. Okay, questions. Then the crowded, then the cover call goes down. My guy, DHF, then the cover call goes down. Yes, so you're getting 5% a month. Let me explain that. Yes, okay. You get 5% a month on the premium. But what if the stock drops 5%? Yes, so then you basically it's a wash, right? Let's say the stock drops 10%, right? Well, now, guess what? Let's do the math. If you get 5% a month on a cover call, and the stock drops 10%, you're in the hole, right? It's going to take 2 months to do 2 cover calls to get out of that hole to get back even. And then what? Then you have another 10 months or 8 months left in the year. Ideally, you're going to just write 10 or 12 cover calls in a year. Let's say you get 50% return. Say the stock's down 20%. Minus 20% plus 50% is a 30% profit. Hey, you're still up 30%. I won't get mad at you. You're still at a much better place than the regular shareholders that lost 20% in their stock because it was a shitty stock, because it wasn't a great stock, had no PE, had no stock splits, no robust share price, no chart, and it went down over time. They lost time and money. Well, you made some cover calls, and you still got 30%. So you're still above the average shareholder. That's why cover calls are good, because they're going to come in every month that you do the call. See, the stock's not going to drop every month. You know what I mean? But the cover call will come in every month. And that's the difference. Questions? What if the price of DraftKings goes down? Yeah, so I just explained that. So if you have the shares, just like you have an apartment, right? 10 unit. Let's say it's worth $1 million, right? Let's say it goes down 20%. Oh, you know, I'm so upset. My apartment went down 20%. Now it's worth $800K, right? But guess what? I can still rent all those rooms, right? Same thing with stocks and cover calls. The share price can come down, but you can still write your cover calls. As long as you have 100 shares and there's an option chain, and there's, write this down, volume, volume, volume. Heavy volume is very key. As long as I have volume, then and option chain, then you can write cover calls. If you are bullish in the stock, do you sell calls? Net Wink, do that. You guys got crazy names, bro. Who this? Net Wink, who this? Good question. If you are bullish in the stock, do you sell cover calls? Great question. See, now you're thinking, now you're using your noggin, right? Okay, so you might think that a cover call is a short position, meaning that you want the stock to go down. Not the case. I do cover calls, I want the stock to go up. Because what? Because of the way I do cover calls, the way I'm going to teach you guys, show you my system, is you buy, let's say DraftKings. Let me not use DraftKings. I don't want you guys to jump on DraftKings. Only if you really like DraftKings. Let's do Palantir, okay? You buy Palantir for $44, okay? $44.76 today. Look at this, 50 million volume, right? You go 30 days out. In this case, you click all. You go to November 29th, 33 days, 34 days, close enough. And watch this. Palantir is 44.76. So you agree to sell it. I'm sorry. So you invest $4,400. Makes sense? About 100 shares, okay? You agree to sell it for $47. For $47. Okay. 47. And that way you sell the call for the 47. So if it passes 47, it'll get assigned, it'll sell. They'll cash you out at 47. You'll make, what does it say? What's the premium for this? Look at this. This will blow your mind. $281.98. The premium went up actually since the last time I checked. It's $281 by $298. Bid ask. I'm not lying. Check it on yourself. If you don't have a stock market account, you can go to Yahoo Finance and pull up option chains, or just go anywhere or pull up option chains 1 month out. Look at the share price. Go higher than the share price, right? Right, because we want to make share growth. So we buy it for $44.76. We agree to sell for $47. There's $2.24 point share growth right there. I'm giving you this. I'm telling you, there's 1,000 options for each of these stocks because there's monthly, every month. There's weeklies. There's different strike prices. I'm giving you the exact option, the best one to make the money to pay your bills every month and retire. Okay? You want to buy the shares here at the market. Sell the cover call 47 strike November 29th. That's 30 days out. And you keep doing it every month. You're going to get paid $281 bid. Now, $281 by $298, there's no reason to put a limit order because it's right there. You're not going to save much money, and you might miss a move. If the stock is moving, you're going to miss a move. Just do market order. So now let's do the math, okay? $281 or $281 divided by your investment, which is $44.76. You ready? Write this down in your journals. 6.2% return. Hello, 6.27. So really, if you want to round up, it's 6.3. 6.3% return per month. 63% return a year, because I always tell you, write 10 cover calls a year. You can take 2 months off, but work 10 months. 10 cover calls will give you 63% return. Yes, the stock might drop some. Yes, it might go down, so you might not make 63%. If you made 50%, I won't get mad at you. If you made 40%, we'll get mad at you. But the stock would have to drop 60% for you to break even. You understand what I'm saying, okay? Do the math on your own. Double check all these numbers. You know, I've done hundreds, thousands of these trades. I'm just showing you my experience, what works, what doesn't work. And the thing about Palantir is it has a lot of check marks. It has volume. It has a cover call. It has PE. Not much PE, but it has PE. Different things. I have 11 check marks. I have 11 stock criteria. And different, if you go to my profile, you see my hourly videos. I record these for you, put them on TikTok. You can go back on my profile, watch all these videos. You can get my 11 criteria. They're there. And if you have these criteria, your stock will probably not really go down too much because it's a great stock, because they have a great product, because they're hot for some reason. They're hot to trot. And probably it'll maintain in price and go up, and you might even get more than 63%. And then you can thank me. And then if you're not working at Walmart at 75 years old, collecting receipts at the door, working at McDonald's, taking orders at McDonald's, working at a movie theater, collecting movie tickets at 70, 75 years old, you can thank me that you had some shares. You're doing a cover call for $3,000. You started $3,000 in October 2024. Is that too much? Oh, but the question was, should you sell calls if you think the stock's going up? Yes. Let me tell you why. Because even if you think the stock's going up, and the level may go up, it's not going to go up every month like that, every month to month to month. So you're taking a premium, in this case 4%, 5%, 6%. You're giving away some of the upside. Some, not all, some of the upside. And you're able to get a predetermined income every month on these premiums. Every time you have 100 shares, write the cover call, you're getting a predetermined income, $200 on DraftKings, $250 How much was it on? How much was it on Palantir? $280, $281 on Palantir. What would $280 do for you? Maybe pay for your gas. Take your wife out a couple dinners, you know. Get you out of a doghouse. Maybe you can buy more shares. If you keep building up, you can just use that money to buy more shares. Eventually, you'll have 200 shares. Then you write 2 covered calls, 300 shares, 400 shares. Exponential growth. I'm not gonna stop you. What's your favorite stock to watch? Netwick. Favorite stock. But back on your question, if the stock was really gonna go up like crazy, you wouldn't have to write covered calls. What you can do, just hold the stock, and when it went up, you sell it, make a profit. The thing is, that's easier said than done, because we don't have that foresight. We have to look what it did. We have to look hindsight. We don't have that. We can't, unless you have a crystal ball, you're not going to see the future. So instead of trying to guess where the stock's going, just write the covered calls every month. Ideally, your stock's going to go up. Let it go up. Another thing about covered calls is, if the stock passes 47 for Palantir, or it passes 38 for DraftKings, you're in a covered call, it will sell. You'll get cashed out. You have to buy it back and do another covered call. Big deal, right? Your price might be higher. Big deal, because you can still buy it back and do another covered call. But if the price is higher, you got to pay a little more for it. That's one of the downsides of doing covered calls. That you will get a sign. They will sell out. You'll sell your shares. What I do, I have a core 10 stocks list. Write that down. And if my cover call gets taken out on the upside, it sells. I'm happy. I get maximum return. But then what I do, I'll wait. I probably won't get right back in. I'll probably wait. Like, oh look, Netflix took off, Tesla took off. They sold out now in my cover call. Palantir took off. But look, Starbucks is down. Hey look, NVDA dipped. Hey look, AMD. Apple dipped, so I'll get in on the dip. So if you're watching a handful of stocks, and I think probably a lot of you guys are, even though your cover call swings up and sells out, you can wait. You'll have the cash just sitting there in your account. You wait for one of your stocks to dip, bam, and you're back in. So you can literally go like from if you're behind your stocks. Don't just do random stocks. You know, you can literally go from Palantir, jump to NVIDIA, jump to Netflix, jump to Tesla, jump to, and for some people, not me, but for some people, DraftKings. And you can just keep doing covered calls. The idea of coming in on a dip is that you're not paying maximum dollar for your investment. You're getting it like a little bit less. You're getting it for a little bit. What dividend investors will do, dividend investors like to get that dividend, but when their stock drops, they buy more shares because they're getting the higher return on the dividend. They're getting in their mind, they're getting a discount. Same thing with cover calls. Wait for one of your stocks to dip, jump in. Wait for it to go up, then do the cover call. Makes sense? Appreciate you guys. Do you just roll over so it doesn't sell? You don't get the contract. Get off Zen X. Do you just roll over and doesn't sell and you don't get off the contract? Great question. Now you're asking. Now I'm getting to you guys. You're asking good questions. The first rule of cover calls is just to let it go. Let it expire. Don't touch it. Write it and walk away. Because why? Because you want to get the maximum price. Because you want to get. You don't want to be trading. This is more mental gymnastics. You know. Yes, you can improve your trade. Yes, you can make more money if you trade. But the first rule is let it expire. Let it go. And just wait till it expires, get the money back, and do it again, okay? So the first rule is to let it go. But if it's a situation where, let's say you're in Tesla, right? And it went up 40 points. Your cover call gets taken out, you know, and you get maximum premium, plus you get some share growth. So you might have made 8% this month on Tesla because the stocks went up, plus you get the share growth to a certain time, plus you get the premium. What I can do is I can buy it back, roll it out for next month. But here's the deal on that. If the stock were to go down after you did that, you would actually end up losing money, because when you buy it back, you put money back on the table. You're going to take the money off the table. When you buy back, you're going to put money back on the table, a certain amount. So it's tricky. So you'd have to really know how to trade to make that, to be buying your call back. You have to really have to, the idea of it is like this, like if you're in Tesla and the stock swings up, then you write the cover call. That's timing, right? And then let's say it drops back down. So let's say you write the cover call for 10 points, which I do all the time in Tesla. That's $1,000, right? And let's say the stock drops back down after I do the cover call. Let's say it drops, that $1,000 call drops to $500. Guess what? I could buy it back at $500. I made $500 profit in like 3 days. And then what? The stock swings up again to 1,000. What? I write it again for 1,000. Bam. Make another $1,000. And then it drops back down in price. The stock dips 10 points, whatever. And the option drops to 5 points. Buy it back again. So I've written the same cover call 3 times in the same month. Win, win, win. But is that hard? Yes. It takes all kinds of mental gymnastics. You have to be there looking at the stock. It's difficult. So it's just like the dividends are easy. Just make it easy. Write the call, walk away, come back next month. You can look at your stock, but you don't got to do all this trading. Buying back, rolling back. You're only going to roll it back if you really think you know where that stock's going. If you can see a trend, if you want to stay in that stock. But for all intents and purposes, the cover call is designed to just let it go, just let it expire. Questions? Guys, if you want to throw me a sub, it's only $5 a month. I can answer your DMs, answer your questions, just one question at a time. And I'll advise on trades. Rinse and repeat. Netwick, rinse and repeat. Yes, rinse and repeat. Rinse and repeat. Dude, that's so true. Axiom curve. Why not just sell puts? If I can show you the put I did on Tesla, when it was 213, stock was down 4 points. Perfect time to write the put. I wrote 190. What did I write? 210, 205. Why not sell puts? So selling puts is a great strategy. I would say it's even better than a cover call, but it's a little bit more advanced because, for one, you don't get share growth. There's no share growth in the naked put, okay? If I sell PLTR, if I have PLTR at 45 and sell at 47, I can get 2 more points on the stock, plus the premium of 281. That's 481. That's like, 10% return. But for the naked put, there's no share growth, so it's just the premium you're getting. So what you do is, you don't own any shares. You just sell a put, just off the bat. You're agreeing to take the stock if it goes below that strike. So let's do PLTR, okay? Go out 1 month, just like cover call, November 29th. If the stock is 476, you want to allow, write this down, a buffer, because you don't want to necessarily take these shares, okay? So I would go buffer. I would go 44.76. I would go about 43, 42. The 42 put pays 228. 228. So you're gonna just -1 put November 29th, strike 42, get paid $228. $228 will do what for you exactly? Maybe help you pay some of your food, pay that DoorDash, right? And here's the thing on the put. I was talking about this last week. They don't actually hold all the money to buy the shares. So you would think that if you're going to take the shares at 42 or lower, and you're going to get $228 to do this trade, that you have to have $4,200. For you guys in Robinhood, yes, Robinhood is whack. They hold all the money. They do what's called a covered put. So you need $4,200 or $4,400, whatever they want to charge you. But for Schwab, they're only going to charge you $2,200 because you have a margin account, because you can't trade with that margin account. And they know that you don't have to have all the money. You only have to have half the money. So they're going to only hold $2,100 to do a 42 strike put on PLTR for 1 month, and let's do the math. First of all, let's do the math for the full amount. I want you to have the full amount because in case these shares get assigned, I don't want you guys to worry. You have $4,200 because you want to have the money to do the trade. So let's do that first. 228 premium on the naked put divided by the share price of 4,242, 5.4%. So it's paying pretty similar to the call, okay? $228 in the $4,200 investment is 5.4%. But, like, tricks to the trade, guys, write this down. As long as you're on Robinhood, if you're in a real investment company like Schwab or whatever, I don't know, Webull might do it. I don't know. I can't. I just know Schwab works best. They only hold half requirement, so it's only going to be $2,100 to this trade. And if you get assigned on the shares, immediately sell. Okay, because if you only have half the money, you're gonna be in margin. I don't want to put you guys in margin. Okay, now let's do the real math. This is why we're doing this live. I'm telling you the tricks of the trade. 228 premium divided by your investment, 2,100. This is naked put. 10%, 10.8% return. Hello. 10.8% return. It is more of an advanced trade. They have covered puts and naked puts. Most of you guys will not do everything naked puts in your life. It's facts, okay? But a covered put even if it's 5%, it's fine. But the difference between a covered put and a covered call, they're both long positions. You don't want your shares to go down on either one. At least not the trade I'm showing you. But with a naked put, if the stock doesn't go down, you just every month just write the naked put again. You walk away. When the stock goes down below 43 in this case, 43, 42. What did I say? Where were you? The 228 is 42. If it goes down below 42, you'll buy the shares at 42, and you'll have the shares. So in this case, you're buying the shares at a discount. Like if you went to a grocery store and say, "Hey, look at that wine over there, manager. If that wine ever goes on sale, I'm going to buy it. Would you pay me for that?" That's what's happening with the naked put. You're getting paid to buy your stock at a discount. It's crazy. It's loco, man. That's why I'm showing you guys these trades. But if you get the naked put happening, yes, it's better. You get 10% return. But it's tricky, man. I know guys that racked up all the naked puts and then downside. So here's the risk factor. If this stock gets slammed to hell, what's going to happen is all those naked puts you're going to get all those shares. And you know how if the stock drops on the cover call, let's say stock drops 5 points and you're getting 5 points for the cover call, it's a wash, right? If the put drops, same difference, you're going to start losing money if it goes below 42. And if it gets slammed, let's say it goes to 20 or 15, it happens. And it just has to happen once in your lifetime. Your whole account can get wrecked, okay? I know people who it's happened to. So have all the money to take the shares. Don't go on margin. Don't get happy. Be very careful doing this trade. The higher level trade you go, the more risk. You can even do, if you're doing naked puts, why not just do a straddle? Because now you get paid both sides. I'll tell you that next time. You get paid both sides on the straddle, and you can only get assigned one. So they're only going to charge you for one side. You get more return. All right, guys, let's wrap up. Thank you, Axiom. Axiom, appreciate you. Everybody follow Axiom. Axiom Curve. He's a stock market trader. I'm going to come on back Monday night. And you guys want to sub, you can talk to me. I'll walk you through your trades, show you these trades. I can look at your stock. I have a Core 10 stocks list. I've showed you my Core 10 on different lives. You want to look at my stuff, look at my videos on my profile. I know I mentioned Netflix today. Netflix is one. FLX, Starbucks, SBUX, WHF, William Harry Frank is the dividend. WHF dividend. NVDA, NVDA, PLTR, PLTR. 1, 2, 3, 4, 5. 5 is enough for you tonight. I want to explode your brain. You can just throw an apple. You know, apple's in there. AAPL. 6. See, I got your back. I'm hooking you guys up. If you know how to do it, you can maybe get 400% return on a call option for earnings play. If you have both a put and call, you probably won't lose too much money. Probably if stock hits or dumps, you'll probably make money. Got both sides covered. Thank you, Axiom. I appreciate you, man. I'll see you back. If you want to come back Monday. Just buy calls and buy puts. Axiom. Yeah. Okay, so Axiom says just buy calls and buy puts. Now, see, now you're doing a risky trade now. But yes, the theory is similar to having shares of stock. You can buy a call and buy a put. Let's just go out 1 year. Let's just go out to 2026, okay? 14 months out. Let's say you have a great stock, right? Really a stock that has like Tesla, a lot of volume. You buy a call and a put a year out on Tesla, and what happens? What? The theory for this trade is that when the stock swings up like it did, 40 points, now you can sell your call at a profit, okay? But you also have a put that went down, right? But when the stock dumps on the put, then you sell your put at a profit. So in theory, you can sell both and make money. Just timing, right? It's tricky, man. It's easier said than done. Don't make me get you into risky trades. I'm trying to take the risk out of it for you guys. I'm trying to show you how to do dividends, how to do cover calls, maybe naked puts, how to select good stocks, what's trash, what's decent. You know, I think it'll help. You know, thank you guys so much. I'm gonna wrap up. I'll take it 1 or 2 final questions. Holding Boeing puts a month from now. Boeing's been having some problems. I never liked airlines. Too much competition. Unions, you know. You can't buy the product. Well, you can actually. You can buy a ticket to United Airlines. So never mind, you can't buy the product. But so much regulation, a lot of lawsuits. It's much better to go like Amazon, Netflix, something that's just hot to trot and just going up, you know. Less litigation, less problems. Thank you guys. Let's wrap it up. DM me. If you want to sub, it's only $5 a month. I'll teach you what I know. Just one question at a time, please. Appreciate you. God, out.